Palantir, Q4, good results, bad stock. Gonna talk about all that. I'm gonna explain what happened and what I think is coming next in just a second. Let's talk about what happened yesterday, because ever since my grandpa came back after New Year's Eve and fell down the stairs, broke some glasses, got into his Lada Niva, drove into the neighbor's backyard, ran over this garden gnome, I haven't seen a cluster freak like this until the Palantir Q4 financials.
Our earnings call from Denver. It's my maiden voyage.
Numbers are impressive, and yet the stock tanked.
And that's because Palantir Technologies is out with quarterly results this morning. The software platform company reported adjusted quarterly profit of 2 cents per share. That compares to a consensus estimate of 4 cents. So you're going to be seeing that stock already off about 3% this morning. Revenue did beat Wall Street forecasts. We're going to keep our eye on it.
We did see 1.5 billion in revenue, give or take, which is basically what I expected, and I think most analysts expected. So nothing to write home about. It's only 100% growth in 2 years, from 750 to 1.5 billion, since 2019. Not that impressive. I mean, every company grows 100% revenue in 2 years. Of course, I'm being cynical here, in case you didn't pick it up, but it is what it is. Now, the other thing I was looking at here is free cash flow, because free cash flow is basically operational efficiency. I want to see how much money the company's making, because I hear a lot of people talk about, well, Palantir is not profitable. Hardly har. Well, 424 million in free cash flow from operations, not loans. Seems like 30% to me. So for those who that are here saying that Palantir is not profitable, I find that kind of laughable. But that's not the reason why this stock tanked. There's plenty of other reasons, which we're going to cover here in a second. So I think there's a multitude of reasons that caused this. Because first of all, as you may have noticed, yesterday, the entire stock market took a beating. I mean, everything was so red. Communist parade. Every single stock was red. A few exceptions here and there, but mainly everything was red. That still doesn't explain what happened with Palantir, because even though, stocks like Nvidia down 7.5%, AMD down 3%, even Snowflake, the beloved Snowflake, is down 6%. So it's still not as bad as Palantir. Palantir dropped 15%, so there had to be something else. So obviously the entire market took a beating, because at this point, we're basically being managed by President Putin. Every time Putin says or doesn't say anything, the entire stock market behaves like a manic depressive grandpa in his Lada going backwards, without a visor. I mean, at this point, I think Putin is secretly enjoying dicking around the stock market. Every time he smirks, something happens. So he either has puts on this market, or, he's just enjoying the ego trip of basically driving the stock market insane.
Well, he was putting us on, huh?
But basically, there's sounds of war intensifying again out of Ukraine after actually mellowing down just a few days ago. So everything is going back to red. That is only a partial explanation of why Palantir actually took a beating. The other part of what happened yesterday, which is not financially or fundamentally driven, is something that you can't really change, which is Alex Karp's personality and attitude. I mean, it is what it is. That's the guy he is. And I kind of like it, to be honest, but I know a lot of people get triggered. He's arrogant, and he's aloof, and he thinks that he's better than you. It is what it is. I mean, he basically gave the middle finger to the entire industry by moving out of, San Francisco all the way to Denver. And he's basically saying, well, we know better, we are better, and you're all, not as good as us. And that's fine. I kind of like it. But if you're going to say that, you got to beat earnings. You can't miss on EPS. I know nobody cares about EPS in the industry. I know. Actual analysts only care about revenue growth and commercial growth and, free cash flow and operational margin, stuff like that. Nobody really cares about EPS in the industry. However, the fact of the matter is that they missed. So, it's irrelevant. We can talk all day about how stock-based comp drove it down, and if without stock-based comp, there would have been much more profitable gap would be general accepted accounting principles. So that's all true, but I mean, if grandma had wheels, she would be a bicycle. Who cares? The bottom line is, there's a miss next to the name, EPS miss. With such a high participation of retail investors in Palantir, there's literally like 70 cents on the dollar of retail investor money in Palantir versus institutional, which is almost a reverse from what the other big companies are. Nvidia has 70% institutional investments, similar to Snowflake, similar to AMD. They all have 60 to 70% institutionals. Palantir has it the opposite. So only 35% institutionals and increasing quite rapidly. Companies like BlackRock, Goldman Sachs are, pouring in, but still only 35%. Until we have more institutional investors in Palantir, which don't care about EPS and empty metrics like this, we're going to have this manic depressive volatile behavior. And, Alex's demeanor, I guess, will be always a part of it. But it will change, I guess, when we'll have more institutionals taking over retail money. Now let's talk numbers, because there were some numbers that actually drove down the performance of the stock. Obviously, the annual revenue beat was impressive. They beat expectations quite significantly. 41% annual year-over-year growth in revenues instead of the guided 30%. 47% government growth, 34% commercial growth. Everything across the board, is performing excellent. So why is it tanking? Where's the problem? So the main thing that we saw that was kind of alarming, and we talked about this during our live stream when we were talking about the financials as they were coming out, is that we're seeing quite a significant deceleration in the pace of government business growth. So it is growing, but the pace in which it's growing quarter over quarter is slowing down, which is, again, something that we as long-term investors in Palantir know about and understand, that the company is pivoting away from government contractor to a commercial software provider. And that's part of the process because there's only so much TAM in the government side of things. I mean, there's a glass ceiling there. You have to pivot away from that into the commercial sector, and that's exactly what they're doing. But that pivot comes with a cost. I mean, retail investors are looking at Palantir and saying, even maybe some analysts, well, right now, 60% of your revenue is coming from the government business. And if that's not, as fast accelerating as we thought it would be, then we don't care about your pivot. I mean, it is what it is, and I get it. But for those of us who are there long term, we kind of expect to see that and not really alarm. But that's kind of the both sides of the story here. So I totally understand people who get freaked out by that, but I also totally understand why that's not a big deal to people like me, who actually see this pivot is actually as an important thing. Now, let's talk about the other part. Now, on the commercial side of things, where we see the massive growth, which is exactly what I wanted to see, is there lies a little problem beneath the surface, a little of a problem. The problem is that if you look at the US commercial growth, let's just say 100% just for simplicity, 100% commercial growth in the US. It's amazing. However, if the US grew by 100%, how we grew 34% in pretty much the entire commercial sector? That means that the rest of the world, ROW, is pretty much non-existent. And that's kind of a self-imposed restriction that Palantir is creating for themselves. I mean, they're not willing to take a lot of business because of their government affiliation. And I'm assuming that loosening up of their ability to take more and more commercial business that's not as restricted is going to take time. The more they get away from the government and into the commercial sector, the more they're going to be able to loosen it up and get more business through the door. Now, the next thing that actually is alarming to a lot of retail investors and a lot of the algorithms is the EPS, earnings per share. Now, earnings per share was only 2 cents instead of the expected 4 cents, which is half. So it sounds dramatic. The problem is that nobody gives a shit about EPS in the industry. However, retail investors do, and the algorithms do, and that's why you saw the big sell-off. For me, and for I think most analysts, and again, you can comment below and share with us your opinion, especially if you have industry experience. When you have top line growth, which is revenue growth, when you have high margins like they have, when you have improvement in the margins, when you have operational free cash flow growth. So basically a company that grew 41% revenues and improved EBITDA and generated 420 million in free cash flow from operations from 1.5 billion in revenue. When you see that, it actually is way more important than EPS numbers because it shows you that the business model is working, that it's strong, as the company is growing, and it's heading in the right direction. However, I get it. Still, at the end of the day, that's all excuses. EPS is a metric that is there, and they're going to have a miss next to the name. It's like playing in a basketball game and saying, well, I had this easy layup, and some guy just flagrantly fouled me, and I missed the layup. But the referees never gave me the call. They never blew the whistle, so we lost the game. Nobody cares, my guy. I mean, you lost the game. So EPS, as far as, not being relevant, I'll completely agree with that. However, It's a mess, and that's why, they're getting punished. It is what it is. Now, the next thing is basically that I think there's sandbagging guidance, and they've been known to do this for a while. As you notice, they're still guiding for 30% until 2025 and only 440 million for Q1 of this year, which is exactly where expectations are. Nothing as far as beating the expectations. Now, when you have that kind of guidance, usually it pushes the stock down. Now, they've been known to sandbag these, and obviously you just saw this happen. They guided for 30% this year, they did 41%, but I think it loses the effectiveness of it when people are expecting you to do it. So at this point, everybody knows that that's kind of the MO of Palantir. So I don't know if that necessarily is the right decision, but I think this kind of low-end conservative guidance is partially what's holding back the stock. Now, as far as things that I was looking at, which is of course the free cash flow, the revenue, I was also looking at one more metric. I don't like the fact that they have too little clients. I want to see growth and client count. So coming into this quarter, they had 200 clients. They grew by 17% their client list in a single quarter, which is very nice. But more importantly, they actually grew their client list year over year on an annual basis by 71%. Again, very impressed by that. Exactly what I've been looking for. And the other thing I was focused on is the commercial growth. I wanted to see an acceleration in commercial growth versus the deceleration in the government growth, which is exactly the pivot I was talking about. And we got that and some. So, nice commercial growth, 34% on the year. But looking at the numbers quarter over quarter, you see a massive incline. 19% first quarter, 28% second quarter, 37% third quarter, and 47% growth in the commercial sector in the final quarter of the year. So the commercial sector growth is actually accelerating, which means it's exponential now. I'm really excited about that part as well. Not to mention the fact that if you look at the US numbers, the growth in the commercial sector is insane. US commercial growth in this quarter was 130%. Annually, 400%. They went from 17 to 80 clients on the US commercial side. I mean, that's just something you can't ignore. However, as I mentioned before, they still fell short of the expectations because even though they did 432 million in revenue, opposed to the 418 they were expected to make, still the EPS number, the EPS miss of 2 cents versus 4 cents is basically what's pushing them down. That's part of the business. If you want to be on Wall Street, you got to be able to talk the talk and walk the walk. If you've been saying I'm better, you got to beat EPS. There's no excuses here. But I mean, you got to love the clients that they have. They just signed 64 new deals in this quarter alone, which are worth 1 million or more. Out of those, 20 deals worth 10 million and more. I mean, they have some of the best clients in the industry. That sort of commercial growth isn't these kind of small, low-level, little tickets. These are the big ticket clients, and they're getting them in a bunch. But again, if you're not going to hit the GAAP profitability, the generally accepted accounting principles, basically, you're not getting it done. Now, for me, when I see a company that's not hitting GAAP profitability, I'm looking for two things. If you can't show me GAAP profits, show me two things. I want to see improvements in margins, and I want to see growth. Obviously, as far as growth, we just talked about it, have plenty of. As far as the margins, actually quite impressive. So their margins on an accounting basis, on a GAAP basis, with stock-based comp, which is not a cash flow item, by the way, it's just kind of an accounting number, they're actually improving. They went from negative 49 to negative 14 operating margin by these last 4 quarters. Now, if you take out stock-based comp, which again is not a cash flow item, it's an accounting line and it doesn't cost the company any money. Of course, it dilutes the shareholders, but it doesn't cost the company any money. Without stock-based comp, this company is operating on 30% operating margin. That's quite impressive. And that's exactly why they had 424 million in free cash flow from operations. But again, stock-based comp is something we have to talk about it. And there's no time like the present, so shall we? The thing with stock-based comp is Wall Street doesn't like it. Now, it's true that stock-based comp is the best way to attract top-tier talent, especially if you know you're going up against a Microsoft in a couple of years, which is quite likely to happen. You want to attract the best people possible right now and lock them in with stock-based comp. I get it. The problem is that Wall Street hates it, even though they know it's important. But to their defense, Palantir have been actually improving in that as well. Stock-based comp and dilution have been going down drastically. So this quarter, the share count of Palantir only grew by 2.5%, from 1.96 to 2.01 billion. So it is slowing down, it is actually getting better, but until it completely halts, people are going to be complaining about it because they're getting diluted and they don't like it. It is what it is. Now, the thing with Palantir is, regardless of the stock-based comp or what you're going to say about their GAAP profitability, they're 5 times cheaper than Snowflake on a price-to-sale basis. So they're trading at, 14, 15, 17 price to sales, depend which day you're going to check. Now, the bottom line here is quite simple. Palantir had great Q4 financials. They beat expectations on revenue, on cash flow, on margins, on anything besides EPS. But somehow, they're still considered expensive even though they're trading at 1/4 or 1/5 of price to sales compared to a company like Snowflake. The bottom line here is quite simple. It's a company with great growth, amazing moat, great margins, and some of the best clients in the industry. As long as they continue to grow at this pace and they continue improving on their margins and they're going to stop and keep slowing down dilution in stock-based comp, they're going to be killing it in just a few years. However, not all of us have the patience for that, and that's fine. Some of you may say, well, there's better alternatives out there for faster improvement on ROI. That's okay. For me, I think that's a generational company. But then again, what do I know? It's just my opinion. I'm just a guy in a tracksuit. Do your own research. I'm not a financial advisor. Make your own decisions. I think that Palantir is the next best thing since sliced bread. But hey, it's just my opinion. Before I let you go, I want to give a huge shout out to our channel members and our Palantirs in the Patreon that are supporting this channel with $5 per month. If you want to be a part of that community and participate in our Zoom calls, in our Discord, we don't have trade alerts there, obviously, since we don't trade. However, if you want to be a part of the community and you want to support the channel, we're more than welcoming you to join us. $5 per month. The link is going to be below. I'm assuming there's going to be 1 or 2 people to join from this video, and that's okay. We're happy to accept the 1 or 2 that really want to support us. Thank you so much. We'll see you in the next video.